Hello and good morning, folks. Welcome back to Almus Market Mornings with Shikhar Garg, and it's the RBI MPC meeting day today. There's somewhat mixed expectations by the market participants about the central bank's actions, but some increased inclination are being observed for a possible 25 basis hike. Now, today's outcome should definitely be setting the USD INR's direction for a couple of weeks, as it hasn't been much in correlation with the rest of the world's currencies. Which also brings me to J.Powell's who currently is the Fed chair, speech yesterday, where he's been seen pointing out the beginning of disinflation. Also mentioned that the jobs data was a surprise, and such numbers hint for a continued restrictive policy for a longer time duration. That too at a higher rate. So, JK, what's your thought? What are your observations of these updates?
Yes, good morning. We are back to watching central bank's words. And yesterday was the first of it. Powell at an interview in Economic Club of Washington. His remarks were pretty similar to the tone set after the last Wednesday's Fed meeting. It was a message of data dependency, and he emphasizing what conditions require more or less, a restraint as the Fed watches how the economy responds to rate increases approved so far, and particularly whether inflation continues, what has seen a consistent decline since the middle of last year. He said that significant drop in inflation could occur this year, but with strong data, Fed may go beyond what the dot plot actually indicated. So actually the first part was pretty dovish, where people bought bonds, sold dollars, and bought stocks. And later on, when he said that he may go beyond the dot plot indicator, depending on data, bonds were sold back, but stocks held on to the gains, and dollar also, ended weak. Powell's reluctance to say that January blowout jobs data necessarily meant interest rates need to be higher than Fed official estimated. Not saying that they will definitely do. That is what the market has taken as dovish and sold the dollar and bought stocks. We also had hawkish comments from former Minneapolis Fed President Neil Kashkari saying it's hard to imagine strong jobs growth can occur with growth in wages moderating. I'll look at it still as strong wage growth and other indicators. He also said if financial conditions are easier, we have to do more on rates and do more with other tools as well. So the rising concerns among Fed members has been that the financial conditions have remained easy despite hefty rate hikes, and more on the way, which could ultimately result in second round effects on inflation. So for the markets, it's important how this is managed by the policymakers. After these statements, futures show Fed overnight lending rate peaking at 5.12%. Yes, now the dot plot and the market expectations are matching, but also looks for later declining to 4.785. That's about 40 basis points nearly by December on expectations that Fed rate cuts can come as the economy cools off. Let's not lose sight of the yield curve between 2 and 10 year, which is remaining inverted for over 7 months now and remains steep near 80 basis points. Post Powell's speech, it has ended the day with more steepening bias, with 2-year rate, 5 BP lower related to yesterday's levels. On the Wall Street, Dow Jones ended 0.78% higher, S&P and Nasdaq posted well above 1% gains. The benchmark bond yields crept higher, with the 10-year in US rising to 3.68%, while the German yields also rose to 2.36%, despite a very weak industrial production number. Another development yesterday was a major move in oil, which jumped more than 3% after Powell eased market concerns over rate hikes, while recovering demand in China also boosted the prices of oil. Dollar's correction to steep falls in September may halt for now, as we await more clues from the economy and the inflation numbers next week. Amid all other noises, market has not noted the nil progress made on debt ceiling talks, which may suddenly start to influence the screens. So keep a lookout on the debt ceiling talks. On the currency, especially Euro was down at 1.0670 just before Powell's speech. And that's a level where a lot of technical points converge. 23.6% Fibonacci at falling trendline resistance, as well as the 55-day in exponential moving average as well. AUD and yen were the star performers yesterday, with the Australian dollar rising more than 1.5%, with the hawkish hike by the Reserve Bank of Australia, and the Japanese yen made much more gains on the other currencies in New York session, as the market reacted late to the wage increases in Japan. In fact, dollar yen had gone to above 132.50 post this news, but I think on a reassessment, market have sold back the dollar yen to below 131, although it now trades above 134. So there's really a clear division of thinking among the market participants about where the dollar yen is headed. But definitely something to note out is the Japanese 10-year yield, 10-year bond yield, which is really closing at 0.50, the cap that the BOJ monitors very closely. Now on to the next central bank event, that's RBI meeting today. Decision to be announced by Shaktikanta Das at 10 a.m. Consensus is for 0.25% hike, which will be the smallest in this cycle, and possibly an unchanged stance as well. Focus will be on growth and inflation projections. Market will be glued rather to any hints of central bank reactions to the current financial market turmoil, as also if a pause in rate hikes is around the corner. Some expect a pause after this meeting, as inflation is now consistently below 6%, while a minority expect a pause button to be pressed in this meeting itself. However, as major central banks are still on a hiking path, though closer to a terminal rate, and to maintain the attraction of rupee for foreign investors, RBI could stay with the consensus expectations and hike by 0.25%. Announce that the future actions could be data independent and also on evolving global situations. So we do not expect a big impact from RBI policy on the rupee exchange rate, although a pause could see a knee-jerk reaction in USD/INR to the upside. But as we are close to all-time highs in the pair, it may not sustain, and we may see some value selling from investors and exporters, with any speculative attempt to break higher to be met with the central bank intervention. Overall, the broad fundamentals remain the same. We do not see a case for further weakness in the rupee to new lows right now, despite no improvement in the deficits and flows being negative. On the other hand, a gradual move lower in a correction towards 82 or lower may be seen in the weeks ahead, and that depends a lot on the dollar index moves and also how the financial markets behave in the coming days. So I think that there can be a better correlation with dollar index going forward. Technically, range between 82 and 83 should be holding for now, in the absence of any major triggers. And next week's inflation numbers from US and India will be the focus for the markets. Thank you.
Okay, JK, that's quite great. And yes, folks, their RBI updates, as JK mentioned, are to be observed during the day today. And it needs to be seen whether RBI does mention about a pause in the current cycle or in the following cycle, as they look to be in sync with the rest of the central banks. And rest of the central bank have not yet given up on their hawkish mood. And just to talk about the hawkish mood, it was Reserve Bank of Australia which was in the hawkish mood yesterday with a hike, but at the same time, central bank of US, the Fed chairman J.Powell was and still continues to be hawkish. So it needs to be seen whether our central bank changes their course of action or they continue with the same. On the other hand, as JK mentioned, J.Powell was observed with the thought process of having inflation on the lower side. Rather, they were found mentioning that 2003 could be the year where we'll see significant drops in inflation, and they'd continue with data dependent actions on the central bank's policy. That being said, folks, we still have a 2 to 10-year yield curve inverted, and it has continued to stay inverted for the past 7 months. with the difference being as steep as 80 basis point. Now that's quite significant, as it was once one of the very key indicators of recession, and even now a lot of market participants continue to track this indicator as the sign for recession. It needs to be seen how things go about in the coming days, but we shall continue to come up with all the updates as we continue to be in data pack and commentary driven financial markets in these current days. That's it for today, folks. We shall come back again tomorrow with another round of update. Thank you so much for listening.